Hello, everyone, and thank you for joining us for our quarterly investment commentary webinar. I'm Margaret Sargent, Senior Marketing Associate at New Frontier, and I'm very pleased to be joined today by our CIO, Robert Michaud, our President and CEO, Dr. Richard Michaud, and Research Analyst, Vitaly Rabanin. So for those of you who have joined us for this call in the past, we are changing things up just a little bit. So Dick will be covering the introduction to New Frontier Asset Management, followed by a review of the market and portfolio performance from Vitaly. And then Robert will be walking us through a discussion of his perspective in the last market quarter. As always, we'll have some time for questions at the end, as well as a few updates from the marketing team. And just a quick housekeeping note before we begin, your lines will be muted for the duration of the call to reduce ambient sound. So if you do have any questions, please submit those using the chat function of GoToWebinar. And please feel free to submit those questions as they come up. We'll be keeping track of them throughout the call. So without further ado, I will pass things over to Dick.
Thank you so much for joining us this afternoon. My role is very simple, just to introduce New Frontier very briefly. So who we are an institutional research and investment advisory firm. We are a global software provider with multi-patented software. We are institutional multi-asset ETF manager for well over 13 years. We have published research in modern finance and investment technology. Our signature technology and portfolio optimization was originally published by Harvard. And we have multiple referee journal articles, monographs, academic and professional presentations. We have a very active research program here, and you can find out more in ResearchGate and SSRN. Our investment philosophy is basically institutional quality core, a global core multi-asset manager. We are strategic, but we are not static, and we are not rule-based. We are actively optimized asset allocation, and we are actively monitored and rebalanced asset allocation managers. We optimize both the short and long term. We are state-of-the-art investment technology managers. We are the inventors of patented portfolio optimization procedures, and we are the inventors of patented portfolio rebalancing procedures. We have a continuous research and program here in investment technology. Most recently, we just launched the New Frontier Global Balance Index, which is on our website. Our investment process is actually pretty simple to describe. We produce 6 strategic risk-targeted portfolios from low risk at 20/80 portfolio, 40% equity, 60% equity, 75/25 equity, 90/10 equity, and 100%. Going up the curve, as you can see, yes, you can see. So our portfolios are on an efficient frontier, and as you can see, the portfolios actually do change as they go with the efficient frontier. We have a unified investment process. We examine up to 40 ETFs carefully, very carefully, as our optimization universe, and we use it for our investment process. We have a strategic forecasting procedure. We optimize and rebalance, and this unified procedure then can be turned to either total return optimization, which means global strategic asset allocation as standard portfolios, or after-tax optimization, or income-seeking optimization. It's a strategic process, and here, basically, just to describe it a little further, we have an asset universe and fund selection procedure that, again, starts with 40 ETFs, depending on the strategy, and then we estimate risk and return with advanced statistics, economic theory, and covered information to get strategic risk-return forecasts. These, of course, are customized depending on the application. And then we have an optimized optimization procedure, the Michaud procedure, and the Michaud rebalancing procedure for rebalancing portfolios when they become less optimal. We are an independent ETF manager. We're very proud of the fact that we are. We're not using just any particular set of ETFs. We have domestic equity ETFs, the international equity ETFs, fixed income, government and corporate ETFs, and we have alternative ETFs The process of choosing the ETFs goes through a very, very rigorous process of tracking error and maturity, and most importantly, the customization of the ETFs indices for our procedures and for our portfolios. We are globally diversified ETFs. We care a lot about, let me just make sure to do this again, global diversified ETFs, because we want to span the global investable economic value. Many more opportunities to add investment value, and a purely domestic view is often misleading. It's not really an optimal solution. So we do optimize, but there is plenty of things what not to do. What many managers do is they have a bond portfolio, they have a stock portfolio, and then they just simply link it linearly. In other words, the 60-40 portfolio may be somewhere along a straight line at 60% in this bond portfolio, 40% in this bond portfolio. A 75-25 or a 90-10 portfolio is just more of the stocks, less of the bonds. That is not the right answer. What the right answer is to be on the efficient frontier. And as I think almost everybody knows on this phone call, you can get more return for the same level of risk or less risk with the same level of return. And also the portfolios at the top of the curve have different kinds of assets from the portfolios at the bottom of the curve. It makes a lot more sense from the point of view of understanding optimized portfolios. But the problem has always been that these the optimizers are very, very unstable, and small changes in the inputs lead to large changes in conclusions and so on. They're poorly diversified often, hard to manage often, poor performance often. So just to illustrate what's going on with the problems with optimizers, we have 10 asset classes, 30 years of historical real returns. They're all small cap, large cap, money market, and so on. We plugged it into an efficient frontier. And instead of showing you the efficient frontier, we're showing you a composition map. And so at the left-hand side is the bottom of the efficient frontier. The right-hand side is the top of the efficient frontier. And these are color-coded allocations. So what this represents is at the bottom of it, on the frontier, is money market. Here in the middle is intermediate fixed. Near the top is long-term fixed. And for this particular data set, the dominant asset was small cap value. Of course, different time periods, different asset classes will have different results. However, what you're seeing here is this is a purely optimized portfolio. It wasn't chosen for being eccentric at all. And what you see is for particular points on the efficient frontier is just two stocks or two assets. Optimization done well is a very different kind of optimization and is our patented Michel efficient frontier. We use Monte Carlo simulation to calculate all of the many ways things can happen that are consistent with what you think we know. And these are optimal allocations. So this is an efficient frontier that truly did not exist before we invented it, Robert and I. And it has many different kinds of risks associated with the Monte Carlo simulation. And as you can see, simply taking the data as I was showing it to you before, you have much better diversification with Michel portfolios. And if you think that Robert and I are not good enough to mathematicians to have solved the problem, the World's Authority says that we did. And the final thing that I wanted to talk about today is just the portfolio rebalancing process. And it's a statistical need to trade rebalancing rule, which is truly unique. Again, it's a patented procedure. It's a statistical similarity test between the portfolio you currently own and the portfolio you currently think is optimal. And so every point on the Michel efficient frontier is an average of properly associated, simulated optimal portfolios. And we can use those portfolios to actually compute a need to trade rebalancing probability. And that's how we rebalance the portfolios. So to summarize, we are globally diversified, we are tax efficient, we have 6 strategic risk levels, we optimize both for the long term and the short term. It's multi-patented investment technologies. And at this point, I am going to turn it over to my associate and colleague, Vitaly.
Thank you, Dick, for your overview of our investment process. Now I'm going to provide a brief overview of the performance over the last quarter. First, let's take a look at the global market's performance. On the chart, you see two bars. The left bar, teal bar, indicates the quarterly performance, and bar on the right, violet, shows the trailing 12-month performance. Quarterly performance over global markets has been mixed. U.S. large cap and small cap securities pretty much were flat over the last quarter. Domestic bonds were slightly negative. Europe and Japan posted slightly negative performance, but emerging markets were generally positive for the quarter. Now let's have a more granular look at the asset class performance. At the very top, we have emerging markets, especially China. They have performed very well during this quarter, international treasuries and gold. Positive performance from international treasuries and gold shows how important it is to have diversifying asset classes in the portfolio, especially during times of volatility like these ones. At the middle, we have U.S. large cap equities, short high yield, international REITs, and other asset classes. And at the bottom, we have duration, such as long treasuries, long corporates, U.S. real estate, Canada, and Switzerland. So pretty much consistent growth of all asset classes in unison of the last year is no more, and we now see a pretty much normal behavior where some assets go up, some assets go down, and the rest are mixed. Let's quickly take a look at volatility across different asset classes. On this chart, you see three lines. The blue line is S&P 500. In red is an iShares ETF that tracks Barclays Aggregate Bond Index, and gold line is price performance of gold. Couple of quick notes about this. And they are very topical, especially considering that we often hear phrases such as elevated volatility. Volatility in general is asset class dependent. For example, in this quarter, U.S. large cap equities exhibited higher volatility than gold. But it's known that over the long term, U.S. large cap equities are less volatile than gold. So long story short is this. Yes, elevated market volatility affects all asset classes, but the relationship can be reversed in some instances. So it's important to remember that when you're talking about volatility, it's also important to know what asset class it applies to. Now let's focus on New Frontier performance over the last quarter and the last trailing 12 months. On the chart in grayish teal, you see the leftmost bar is New Frontier quarterly performance. The second violet bar is New Frontier last 12 months performance, and the third and fourth bar are respectively benchmarks quarterly and trailing 12 months performance. In general, New Frontier performance is close to its stated benchmark, with slight underperformance for conservative profiles and outperformance for more aggressive ones. For tax-sensitive portfolios, the story remains pretty much the same: a slight underperformance for conservative profiles and slight overperformance for more aggressive ones. Multi-asset income, once again, slight underperformance for conservative compared to benchmark for the last quarter, and overperformance for more aggressive ones, although since multi-asset income portfolios have only 3 profiles, it's closer than for the rest of our strategies. Let's quickly go over our asset allocation changes that happened over the last quarter. As you can see, we have rebalanced standard portfolios, tax-sensitive and tax-sensitive mutual fund portfolios earlier this quarter. Some common themes across these rebalances are equity appreciation, tax law changes, and rising interest rates that warranted essentially these rebalances. In general, we continuously monitor our portfolios, as Dick has mentioned. We control for interest rates and combine information that we get from the markets on a daily basis and incorporate it in our rebalance test. We believe that these adjustments are going to align portfolios with the risk-return estimates and benefit investors going forward. With this, my overview is complete, and I'm going to pass it on to Robert for his market perspective discussion.
All right, thanks, Vitaly. So, just to give a overview of what I'd like to talk about, I'm going to start with the topic of the main theme of the commentary, which is volatility and that it's returned. It's tax season, so I want to talk a little bit about taxes and including the implications of the new law. And then I'll continue by talking with politics and the economy and their implications going forward. So first of all, the rise of volatility, or perhaps just the return of volatility, was certainly the big event of the last quarter. It's subsided a little bit since then, but the picture I want to say is that it's back. So let's think about just how low volatility was over the last 14 months or so since the election till the end of January. You can see a period of extremely low volatility. You've heard statistics where there are no days, only a handful of days where returns, the market went up or down by more than 1% in the whole year. You heard anecdotes about investors getting into just shorting the VIX and making a killing on that, and it left many people scratching its heads because it seemed like we were in a situation where a lot was happening. Politics and international events were no less risky than normal, but the market wasn't reacting to it. So in some sense, it seemed like finally the market decided it had to start paying attention to what's going on, and volatility came back. It started with a big spike, and I don't think we're anticipating that this will continue forever, but we expect that we're in something of a more normal volatility environment. So I can, just for reference, I have given the last 10 years, VIX was around 20% average. The daily volatility was shockingly close to that for the S&P 500 for 20.2%. But over this period of low volatility, the VIX was about half of what it has been historically, and even that was a large overstatement of what the actual volatility ended up being. The actual volatility ended up being historically low. So the VIX was the lowest in the history since 1990, and actual realized volatility was even lower than that. So that's an explanation in part for how some people who were betting on the VIX, even when it was cheap, it was still too expensive, and so it was a fortuitous bet for people who are doing that strategy. But that's not the sort of thing that we would ever endorse, and that I'm hopefully glad that era of history is in the past. So the other thing to note is that the last couple months or so look a lot like the historical average. We're back up to around 20% VIX and 20% actual realized daily volatility. The one thing I'd like to bring in is the NFGBI. So this is our new index. This is a 60/40 index. It very closely reflects our 60/40 portfolio. And just add that in as a reference point. Obviously, you'd expect it to have less volatility, and it did have extraordinarily little volatility in the previous 14 months. So that's it for volatility. I think you can see the big spike, and which included the largest one-day rise in the VIX ever, and then you can see that it has come down somewhat, and this period on the area on the right is more or less what it looked like historically. So taxes. I would like to be talking about taxes. I'd like to understand really what the implications of taxes are. I would even like to understand what the actual changes to the tax laws were. But some of this has sort of disappeared from the consciousness of the news cycle, at least, and been replaced with our old favorites. But while the benefits are a little bit unclear, and even some of the implications, what the changes to personal and corporate deductions are, still has to be worked out. They think the consensus is that it was hastily written, and we're not completely sure about a few things, and different tax accountants give different answers now. But I'm not a tax accountant, but I am something of an economist. So what does it mean from an economic perspective? And I didn't want to think about this just in isolation of taxes. I wanted to think of it in a bigger picture. So I tried to do some very basic symbolic math as to how all of this plays out. So what I wanted to do here is say, well, taxes are one thing, and taxes, what is the main thing that the taxes do? Well, the biggest part of the tax was lowering the corporate tax rate. And so in theory, what that does is that encourages additional investments, right? It literally makes it more rewarding to be a shareholder or a capital holder. So that should encourage people both domestically and internationally to be investing in U.S. corporations with a lower tax rate. So this should be good for the economy. Now, maybe not so good for the deficit because we're collecting less in taxes, but there's some question about whether in the long term greater economic growth leads to higher tax revenue. So that's a little bit unclear. But there are other big things that are going on that affect the economy as well. There's new tariffs, there's immigration policies, and then there's general economic stimulus. And so all of these things might have impacts on different ones. Wages are particularly interesting, I think, in that, trade barriers, economists do not like trade barriers. They think it generally lowers economic activity, but it could actually provide something of its direct desired effect, which is if you are supporting putting up barriers, then we'll have to do more production domestically, which could be good for wages, especially when you combine that with reduced immigration. Lower immigration means that the people who are here are all that's left, and so they can demand higher wages. That can lead to inflation, however. And so on the one hand, you're doing corporations a favor by making capital cheaper for them and more plentiful. On the other hand, you're not doing corporations a favor. You're hurting them by making labor more expensive. And so the net effect of all of these things, I'm in full economist mode, is that you can say on the one hand, on the other hand, and have no idea what the conclusion is. That will have to play out. Now I'm remembering why we're in finance, where we actually have to make decisions and have to invest in something, whereas economists can just debate endlessly. But this is sort of the economic overview. So how is the economy doing? The answer is pretty well, in spite of everything. So the unemployment is quite low, inflation is moderate and pretty close to where people want it to be. Some argue that's just a hair lower than where they want. I've never loved inflation as much as other economists, so who knows. Growth is moderate. Some people would argue that's a little lower than they'd want it to be, but that has something to that higher growth almost always leads to high inflation. The big word of caution is the dollar continues to decline. So since 2016, it's gone down 12%. And these are big moves. This is not just an individual's wealth going down, or even individual companies going down. This is the value of all U.S. currencies, which is the most stable, or has been the most stable in the world, going down 12%. relative to other economies. So that's quite a significant move, and that explains a lot of you want to keep that in mind whenever you're looking at international stock returns and international bond returns. One of the things Vitaly mentioned is that international bonds were one of the best performing asset classes, and that has a lot to do with the falling dollar. Really, the international bonds mostly just sit there and almost purely react to the dollar. On some longer term concerns about for the economy is that immigration, one thing that doesn't get talked about very much, is demographics, and that immigration has been a big benefit to U.S. demographics. It's been a big, very harmful to much of Europe's demographics, and letting in younger workers help sort of keep the economy going and make us not too top-heavy, where too much of the economy has to support an aging population. The other thing that I think has been underrepresented and should be pointed out is is now really a good time to be protectionist. If we're kind of backward-looking in terms of how much, whether you argue trade with China over the last decade or so has been good or bad for the U.S. or individual in particular, it seems like it's likely to start getting better, because it had to be one way for a while. When you have an emerging economy with no consumers but a lot of producers, then there's nothing that can happen from that situation other than having a trade deficit. But now that China has gotten much richer, they actually may have some demands for not just the California wines you have, but even the intellectual property that America produces. So here's the kind of the fun part is the politics. A lot happened. Too much happened. I have to admit that I want to give Vitaly full credit for one of my favorite sentences of the commentary, where Putin, quote, won a, quote, election. I guess he is much closer historically to Russian politics. I have the benefit of never having experienced firsthand Eastern European politics, but so that happened. The other even bigger thing probably is China elected a president, permitted a president to continue forever, which is a big development, and it's something of a concern for democracies around the world. Things that seem more symbolic: we had a one-day government shutdown, we've had spies dying and threats of a Cold War reemerging, and I'm putting this in order of sort of plausibility. I think the trade war is more of a real concern, although for the moment that also seems to have died down. And then there was some very major turnover in our own government. The Secretary of State was dismissed over Twitter, and what should be important for the economy is the President's chief economic advisor, Gary Cohn, was replaced by Larry Kudlow, who is mostly known as a TV personality. And at first I was a little concerned with this, but then I came to the conclusion of, not a very happy conclusion, but the conclusion of I'm not sure how much it really matters, because a lot of both of these individuals were not particularly influential on U.S. policies as it was. So looking ahead for very direct things that do matter is the Fed. We had 3 short-term rates increases last year. We had 1 already this year. The previous forecast had been 3, but there's been a 4th. That there's some speculation that will happen this year, and that leads us to wondering what's going to happen to the yield curve. So far, the yield curve has flattened a little bit, but mostly it's shifted upwards across the spectrum, although it's shifted upwards more on the lower end than the long end. And so what can happen? Well, if we have 2 or 3 more rate increases this year, then certainly short rates will continue to rise. Intermediate rates will be impacted a little bit more than long rates for that. Usually, the way it works is the Fed controls the short end of the curve, but they only indirectly have an influence on the longer end. And one thing to note is that the approximately 3% rate for the 10-year is not that far away from what history and many economists think is close to a natural level. It's a small premium over inflation, and that's sort of what you would expect. Long rates, however, are a little bit on the low side. So some of this points to a concern that there may be some possible flattening of the curve in the future. We're definitely a new frontier, not one to speculate on these things, but we do want to keep this in mind when we're understanding both the future returns that we're expecting from fixed income and all asset classes, as well as the risks that might emerge that are different from historical risks in investing in bonds. So the consensus is that we're in pretty good health. The tax law is, at least for now, seems favorable to dividends and buybacks and in general stock prices. We'll see what happens with the protectionism, and hopefully won't have too big an impact, but there is some risk of a tilt towards continued influence in Europe and particularly Asia. So the final thing I wanted to talk about today was our index. We talked about this briefly in the last quarterly events, but we have since made an index page, made it more sophisticated on our website, as well as it's being able to sort of view it in the middle of the day every 15 seconds and react to news. It definitely makes me wonder whether people should keep watching the Dow, should they keep watching the interest rates, should they keep watching gold and oil and all these other markets, or would most investors be better off having this as a single summary for what's going on? And so it really is designed to be the best and most representative portfolio or index for the typical investor. You can think about whether they're an individual or an institution. In both cases, they center on something similar to a 60-40. In fact, if you added up all stocks, all bonds, all investable securities globally, you would have something pretty close to a 60-40 mix of securities. And now institutions might say they have a love affair with private equity and hedge funds, and individuals tend to get fixated on commodities and tech stocks and Bitcoin. But I think there's a lot of evidence to say that those fixations don't actually make people better off. And so having more of a focus on the big picture, and finally having a big picture that really is relevant, I think is the beauty of this global index. And so I'm going to try to keep thinking about that and seeing how we can bring it out and make it more relevant to regular people. So I think that's where I want to end. Are we going? And I can hand it back over to Margaret.
Great, thank you, Robert. So we do have time for a few questions. So again, your lines are muted, so please submit any questions using the chat function of GoToWebinar. But I'm sorry, I'm just reviewing the things that have already come in. All right, so people were clearly paying attention. I know, Dick, you talked about the way that New Frontier incorporates current information into the way that we're building portfolios. So I guess people have questions about how both the declining dollar and the changing yield curve will factor into the way that we think about our portfolios.
I think you should take that, though, Robert.
Yeah, so we always want to distinguish between things that have happened in the past and things that we expect to happen in the future. And so while these things have happened in the past, we never know for sure what will happen in the future. There's always going to be, today's prices always represent an equilibrium of competing views. Some people think that interest rates will continue to rise more, and some people think they've risen as much as they will, and maybe even fall in the future. And so that leads us to try to say, well, today's consensus, today's interest rates, especially on the longer end of the curve, are our best understanding of what the interest rates are likely to be in the future. If people knew for sure that long-term interest rates were going up, you could bet that we would not have the 10-year and the 30-year yields where they are today. But then we do want to be concerned with what the risk of these asset classes is. And the risk of these asset classes may need to also be improved, if you will, or updated from the risk that it has been historically. And so I think a lot of these changes do point to a heightened risk for fixed income securities. For the dollar, the dollar is the other part of the question. And the declining dollar, I think, has not fully played out in terms of the value of U.S. securities. A lot of international companies that export products or have global assets have benefited from the falling dollar. But we haven't particularly seen that. That also adds to the risk of the U.S. economy and adds to the risk of these same companies. And that hasn't, although that's recently emerged, that hasn't appeared. So I think being globally focused continues to be a very key point of our investment strategy.
Great, thank you. And then with regards to the index, does NFGBI effectively reflect growth of fees performance of our 60-40 balanced portfolio?
I think that's just a yes. So yeah, yes. So indexes are, I don't think I put index performance up there, but if you do look at it, just like the S&P 500, there aren't any fees that have been taken out of it. It's a theoretical construct.
NFGBI is an index, just like the S&P is an index. And we like to remind people that even an index can't beat an index. So this is an index, and the most important thing you should want to know is that it is not a back test. It is our actual performance starting back in the beginning of October 2004 as an index. And it closely tracks our performance, but it is not our portfolio.
But at least it's a fair fight.
Yes. What we wanted was a fair fight. When people talk about performance, we wanted to have our own index so we would be able to have a fair fight with anybody else's index.
Great. So I think we can wrap things up with just a couple of quick notes from the marketing team. So many of you already know us, but myself and Nick Lamb are here in the office. We are available to answer all of your questions, share marketing materials. So if you do have any questions that come up after the call, please feel free to reach out to either of us. And then many of you have already worked directly with David Schubach. He is boots on the ground, so he is the person who will be meeting with you in your offices, traveling. So I hope that we all get to know you all very, very well. And then in terms of resources, so as always, we encourage you to take advantage of our advisor portal, Frontier Advisor. This is really designed to be a one-stop hub for advisor resources. So this is where you'll find marketing materials, you'll find portfolio analytics, and please do take advantage of this because this is how we make everything available to you guys on a daily basis. And then obviously we've talked a lot about NFGBI, so if you want to read more about it, it is available on our main website under the Index tab, and you can also view our partners website. We partner with Solactive for this index, and the information is also available there on their site as well. And then just a quick note, we just wrapped up a course with the CFA Society of Boston. Dick ran this course. It was Finance's Wrong Turn, a revisionist view of modern finance in practice. We were very excited to be able to share this with the people of Boston, and it took a really interesting look at why investment technology has been ineffective in the past, and why conceptual views of markets and efficiency may be wrong and need to be readjusted moving forward. So we're excited to share this with more people in the future, but for now, just stay tuned. And that is all that we have for you today. So thank you all so much for joining us, and we will see you next quarter.